Okay, everybody, thanks so much for joining us. This is Anna Masker. Thanks for joining our webinar, Creative Ways to Maximize the ROI on Your PPP Dollars. Understanding how you can maximize the return on investment of your people as you're bringing them back to work is what we're going to talk about today. Just a little heads up of who we have on the call today. Mel Comer is my partner. She will be the silent genius behind the scenes monitoring the chat. I'll be doing the presentation today, and we'll have an open Q&A at the end. If you're not familiar with ProfitLink, we do CFO advisory and accounting services for both the blockchain and tech space, as well as professional service providers. We have a team of CFOs and accountants that work with small growing businesses or businesses helping them manage through this crisis, doing everything from helping them manage their PPP funds to cash flow management, cost cutting, as well as day-to-day accounting. So kind of an outsourced accounting and finance department in some cases for some of our clients. So I want to just have, our normal disclaimer that, we're not providing any tax or legal advice today. So make sure you consult with your personal tax or advisor or attorney who knows your personal situations. The other thing that we're going to hear a lot about as far as the theme goes for this presentation is this is an ever-evolving situation. And so our recommendations today may change as guidance is released by the SBA and the Treasury Department. It seems like they're coming out every few days with further clarifications. So what we're going to mention or talk about today may not be something that's applicable in a week or so for now, or it may change significantly. So just know that this is kind of a point in time, but we'll try to keep you informed as much as we can. So in our opinion, there's really some defined steps that you need to take to maximize your return on investment on your PPP dollars. And it is kind of a moving target. So the first thing you want to do is start with your forecast. You can't make any decision on headcount and bringing people back, in our opinion, without knowing where you're going to go, what you're going, or the impact on your organization is going to be. The second thing is you need to understand your potential loan forgiveness and your loan balance, always knowing where you are in the loan forgiveness process as far as your calculations go, and always having visibility to what may be left over on your balance sheet to either pay back or to carry forward as far as a loan is important, so that you're not surprised with a large loan balance at the end of this when you thought 100% was going to be forgiven. The next step is putting your people to work, and we're going to talk a lot about different ways you can do that to maximize the return on investment of your people. And then wash, rinse, repeat. For us, this is this ever-changing situation. Adjust as the SBA provides further guidance. Go back to your loan calculations, understand how that's impacted it. Look at how you're bringing people back. It's a continuous cycle of forecasting, loan forgiveness, and loan balance. Yeah. Okay. So just as a refresher, I know there was a lot of changes that happened when we were in the crux of putting together the loan amounts, and a lot of the rules were changing as the SBA provided further clarification. It's important that you understand what costs can be forgiven, because I think it's also, there's a lot of ambiguity out there. We had two conversations last week where people thought certain things like subcontractor costs would be forgiven, and they are not. So if we didn't have that conversation, that person would be spending thinking that they would get maximum loan forgiveness. So I'm not going to read these, but you can look at the SBA guidance. Basically, salary, wages, cash, vacation, termination benefits, all of those go into your calculation for what you're eligible for, but also what your loan forgiveness is, or deductible payroll costs. The other important definition here is what is the covered period, and that's the 8 weeks from the time the money is deposited into your bank account to the time that 8 weeks starts ticking as soon as that money's been in. So some of you have gotten funding, 2 weeks ago, so you really only have a 6-week runway. Others just got funded last week, so you're in a better shape as far as having more time to make some of these decisions. Also, what's also important to go as a foundation is to remind you of the attestations that you made in the application process. I think over the last week, we've seen the egregiousness of some large companies actually getting the PPP funding. They are cracking down on the second bullet point, which says that the current economic uncertainty makes this loan request necessary to support the ongoing operations. If for some reason you find yourself that you really didn't need the loan, but you got it anyway, you have the ability to actually send it back without penalty by May 7th. Most of you probably on the call have some sort of economic uncertainty. We recommend you document what that need is, whether it's two partners, doing an email exchange saying, hey, I'm not sure I'm going to be able to collect on all this billing that we put out in February or March, or we think this client's at risk and our revenue is going to go down if you have not already experienced it. So make sure you document that need. And then also another thing to remember is that there is a portion of that loan that is forgivable for non-payroll expenses. So mortgage interest, rent, and utilities. Okay. What we're going to talk about today is just as a reminder, the adjustments that go into the loan forgiveness calculation, because those kind of become, it's a good reminder. We have another webinar we did last week. You can find that on our website, profitlink.com/webinar, that talks a lot more in detail about these adjustments we're going to talk about in a second. So I would recommend you go look at that for more in-depth discussion around some of the ambiguities that are in the law and how to maximize your loan forgiveness there. So the first thing we're going to touch on is the adjustment for the reduction in the number of employees. And this is kind of the simplest of all of the calculations, which is basically your average number of full-time equivalents during the 8 weeks divided by the average full-time equivalents during a look-back period. There's a couple different options that you can use as far as your look-back period. And I would check with your advisor or your CPA, or we're happy to help you out in that area to figure out what's the optimized look-back period. Basically, this is a ratio, which is the percentage of the loan that will be forgiven. So if you had $100,000 of PPP loan and you strictly reduce the number of employees by 25%, then that 25% wouldn't be forgiven. It would be 25% of your $100,000, so it would be $25,000. These are just some of the look-back periods. We're going to send a recording of this presentation so you can look at some of the footnotes after. So the first part, like I said, is adjustment for reducing the number of employees. And the second is an adjustment for the reduction in pay. Now this one is a little bit more complex, even though it seems pretty simple on the surface. This is out of the SBA's frequently asked fact sheet document, and it basically simplifies and says your loan forgiveness will also be reduced if you decrease salaries and wages by more than 25% for any employee that made less than $100,000 annualized in 2019. There's some more details in the actual law that we think somewhat contradicts each other. Well, for this purposes, we're just going to kind of go with this global. Basically, if you have a dollar reduction in your salaries for those employees that are under 100,000, that gets directly deducted from your loan forgiveness calculation. So if you reduce salaries by 30,000, the loan forgiveness would drop by 30,000. So that's a dollar for dollar, whereas the other one was a percentage. So those are aggregated those two adjustments. So here's where this ambiguity comes in. There's lots of points of clarification that we need to take into consideration that can significantly impact how you can stretch your loan dollars. You know, and I apologize for the wordy slides, but it's really important that we kind of look at everything in one place. So, you know, there's issues like if your employees' earnings are lumpy, meaning they get commissions or they get quarterly payments, and that pushes them over that $100,000 annualized, but they don't necessarily make over $100,000, you know, because they get paid periodically. Does that mean they're excluded or included? That's yet to be clarified. The same thing goes to, did they really mean to exclude anyone over $100,000, earning over $100,000? So if that's the case, the way that the law is being read right now, theoretically, you can reduce your highly paid employees by more than 25% and not get penalized. There's the third and fourth point of, you know, when they say any employee. So if you, you know, let Jane go and hire Jim, and they are in the same role and the same pay, do you get penalized because you fired Jane but hired Jim, and you don't get the benefit of hiring Jim? So there's lots of things that still need to be clarified and lots of ways that people can game the system. There's also some issues with the comparison period in the law against the full quarter. Okay, so those are the two, adjustment for the reduction in pay and the adjustment for the reduction in salaries are the two things that will reduce your loan forgiveness. And then there's a third clause in the law that's kind of your bonus. That kind of gives you this exemption for rehires, which is pretty much what everybody's trying to achieve, which is, okay, if I restore everybody back to where they were before, then my loan becomes forgiven. And so basically, in simplistic terms, if you reduce the number of full-time equivalent employees, or you reduce the salary of one or more employees from the February 15th to April 26th, and by June 30th, you eliminate the reduction in quotes, the headcount and salary reductions will be ignored. So those two previous calculations will be ignored, and you will have no other, so your loan will then be forgiven. Of course, that comes with its own clarification points. You know, does eliminate the reduction for salary mean you can hire everybody back on 629, pay them back wages, or prepay their salary and still get the loan forgiven? I don't have an answer for that one yet. Technically, maybe you could. Does this include employees that earn more than 100,000 per year, or are they excluded? You know, is there partial credit for restoring some of your headcount, not others? There's just so many ways to game the system on the average FTEs and the salaries that, you know, there's yet a lot to be that needs to be clarified. So, so what does this really mean? It means that there's a lot of unknowns that make loan forgiveness a moving target. And I get wary of seeing, there's a lot of CPA firms that are putting out loan forgiveness calculators and advisors that are doing the same. And I get worried about that because it's not a fix it and forget it exercise. There's a lot of SBA guidance that's still coming out that makes this more of a moving target. And that you need to consistently update and review your projections, and also make sure you have an idea of what's changing in the law. So if it's a moving target, why are we even going through this exercise? So in our thought is, in the absence of certainty, let's go back to like sound financial principles, which means making sure you get an ROI on the payroll spending. So shifting the focus away from loan maximization, which is still an undefined, in our mind, undefined term and concept, to, okay, fine, let's bring back people. We have this money, so let's bring back people. How are we going to do it? You can't make any of those decisions in absence of a forecast. I mean, it's misguided to think that you can just shoot from the hip on this. You absolutely need to know, okay, where am I going to be in this next 8 weeks? So we are putting together, for our clients, we're putting together 8-week forecasts to understand what the short-term projections are from a revenue and an expense perspective, what the demand is going to be, and how many people we're going to need. The second thing you need to do is look at the recovery period, which is, longer term, 12 to 18 months. And if you have that, if you can foresee not just to get to the 8 weeks, but longer to that 12 to 18 months, what that's going to do is give you more of a global view. What does my business look like after this COVID crisis is ending? Or what does the recovery look like for me? Is it slow? Is it fast? What is going to happen to our industry? Which leads me to the third point is there also has to be a strategic forecasting and strategic planning in here about what are the changes that will happen in our industry, or more importantly, our customers' industry as we're coming out of this crisis. Whole industries we've seen with travel and entertainment are all devastated. Event planning are all now having to rethink their business model because the upside or the recovery is going to be so much longer. And then in addition to the forecasts, which are kind of set, we're looking at scenarios. So modeling out to know what your options are, and of course, keeping an eye on the unforgivable loan balance as it starts to play out. The other thing you need to make sure you do is understand the capacity constraints, or how fast you can ramp up. With social distancing and bringing back people into the workforce, can you bring yourself back up to 100% capacity, or are you going to be at a ramp up for people starting? It's really important when you're looking at loan forgiveness is, how much is really going to change in 8 weeks? Surprisingly, when you think about it, we've, at least in the New Jersey area, have been in lockdown or in quarantine, or whatever they call it, restricted, for about 7 weeks. And that has gone really fast for some of us. For some of us, it's dragged on. But how much in your business is really going to change in 8 weeks to warrant bringing back people to 100% salary? Especially if you're in one of these industries that have been devastated. Very few industries are actually doing well in this market. So pretty much a lot of people are down, I should say. And more importantly, what headcount do you really need? So if you, for example, have 10 people on your payroll now, are you going to have 10 people in 8 weeks? Do you need 10 people in 8 weeks? You may be down from 15 in February. How much are you really going to need? And that also really becomes a critical component of how much do you invest in these people to maximize the ROI and help in the longevity of your business. So putting people back to work, really, you have to look at the continuum. On the bottom of this arrow here is, you want to if you want to stay a status quo, there are certain tasks that are more, related to that. So we kind of group the task, or the way you can bring people back to work, into these kind of categories. This is what you can have them do: housekeeping, upskilling, and forward-looking. So housekeeping is kind of like, hey, if I want to stay status quo and operate the same way I was before, there are things I can do to make that happen. Upskilling is, moving the progress forward of your business. So maybe I'm investing in my people for additional training. And forward-looking is finding those new opportunities and revenue streams. So let's just talk about housekeeping. Pretty straightforward. Literally, you could have people come back and do the cleaning, whether that's your physical location or electronically your electronic file system, your physical file system. Of course, there's always work to be done in the accounting arena, whether that's cleaning out open purchase orders or sales orders, fixing your chart of accounts, automating some of your processes, inventories. If you have physical inventory, or even if you have supplies, maybe it makes sense to take a look and see what you've got, what you need, what you don't need anymore. And the same thing goes for inventory as well. Again, all housekeeping items that you can hire people back to that are important. These are things that are important to do. However, you never really had the time to do it while you were, running full bore. So this is definitely a way that you could bring your people back and get some return for that as well. It's kind of putting the foundational stuff in place. Upskilling is really taking it to the next level. You're looking at providing a lot of training in this category: leadership, soft skill training. This is also where it's a good time, if you had your eye on the system you wanted to implement, upgrading the software. Volume tends to be down now. It might be a good time where you have people's attention, where they can test and implement and do training on system stuff, upgrading their software skills, technology training, new systems. Also, there's regulatory training that needs to be done that we have a hard time finding time for: sexual harassment, cybersecurity, etc. So we talked about housekeeping and upskilling. We're going to talk about forward-looking, where I think you're really going to start getting the ROI on your people, and it's a good opportunity. So we're going to stop it just for a second and take a break. And I want you to, on a count of 3, whether you have a piece of paper or you're doing this in your mind, draw a house. Okay? 1, 2, 3. My guess is your house looked something like this, right? A roof, two windows, or maybe 1 window, a door, a chimney, maybe not. But we can think of, I guess the question is, why do we think of a house this way? We kind of all default to, well, it looks like this when we draw a house. It's the same kind of thing. But why didn't we draw this, or this, or this? And the answer is because we always think of the house in the same way. When we draw a stick house, we draw it the same way. I challenge you to think about the way that you're thinking about your business is the way you're thinking about that drawn house. Well, I'm an attorney, or I'm a CPA, or I'm a landscaper, or I'm a lawyer. And so what I'm telling you, and so for us, that is the house. Like, we always think of ourselves in the same way. But maybe, why don't we use this opportunity to take a step back and take a look at our businesses completely? Maybe we offer a new product or service. If we're drawing our stick house, maybe we add a garden or a driveway. So the equivalent of taking your preconceived notions of your business and then blowing it out a little bit more. Can you enter new markets? Can you utilize your people and assets to get new revenue streams? This is where the real opportunity of the PPP program is, in my opinion. You have now been given money from the government to end the time to potentially reinvent your business. And it doesn't have to be a full reinvention of your business. It could just be line extensions. It could be new product offerings. It could be utilizing the assets you currently have in a very different way. So if you have a fleet of trucks, what other things could those trucks do? So we encourage you to use this opportunity for your people to do forward-looking activities or redraw your house. So get together, do ideation sessions. We're starting to do this with some of our clients, and it's amazing when you think about how when we start peeling back the onion and you start, just getting out of the conformity of the box or of the house, and you start just exploring and mind mapping and brainstorming where that leads you to. And we found a couple of clients have already started to, in our ideation sessions, have found new lines of business that they had, which are very small pivots and small investments for them. So use your people for these ideation sessions. Do the market research, have them talk to your customers, have them talk to you talk to your team. Now you have the time, make sure you're doing the financial models on those new ideas. Of course, we're a little partial because that's what we do, but do the process mapping, do the testing, the refining, and keep testing it again. You have an opportunity, like I said, with these PPP funds to take your business out of this crisis into new markets or pivoting, because we think that so many industries, or even the way that we work, is going to change fundamentally. And so you need to be prepared for that. So look ahead and use your team to help you do that. A lot of the people closest to the work actually know the work better and may have good ideas as well. Okay, so that is basically the overview. So, in conclusion, how to maximize the spend on your dollars? Well, of course, we're going to say, don't forget, start with that plan, your short-term, your long-term, your strategic. This is a dynamic process. You need to keep abreast of the law, the SBA changes, and how that impacts your loan calculation. We're doing weekly forecasts and planning with our clients because this is an ever-changing market, and we also want to make sure that we keep an eye on that loan balance of what we think is going to happen. And then put your people to work, the housekeeping, the upskilling, and the forward-looking. And don't forget to redraw your house. So we're going to open this up for questions, but we're here to help you. We can help you create the forecast and project your loan forgiveness, make it a dynamic process. We're always working with reading the guidance from the SBA and making adjustments for our clients. And then we're also doing ideation sessions to help you tease out new revenue opportunities for your business. So if you want to call us for any of those, my contact information is below. I'm going to open it up for questions with Mel.
Hi, Anna. Hi, everyone. Thanks for joining the call.
How do we get a question?
Put it in the chat.
Okay.
Add it to the chat, and I've been picking those up, and we'll collect those so that we get them all covered. So we've had a lot of really good questions asked during the chat session. I'll answer some of them. I'll jump in. Anna will answer some. We'll put our heads together on a couple because there are some real stumpers in here, and we're not sure either because the guidance from Treasury and the SBA hasn't been clear or hasn't even been given. Question, in terms of the applicable costs for forgiveness, can I use money can the money that I use for systems implementation be allowed towards the forgiveness calculation? So in other words, if you are in that process of saying, hey, this is a good opportunity for my company to get that latest version of XYZ software up and running, can I apply those costs as against my as part of the allowable costs for loan forgiveness? And the answer to that is that only to the extent that it's used on payroll costs. If you are buying additional licenses or spending money on other training material for your team, that's not includable in the calculation for forgivable costs. Okay, here's another question. Anna, do client cancellations due to COVID-19 count as documentation?
Yeah, I would include that in your documentations folder to present the need. Yeah, I definitely would say that.
Okay, good. Another question is, I'm struggling to find a definition of utilities, as are many people, so you're not alone. I'm curious if paying our IT support company to keep our computers and internet working for our remote employees would be considered utilities. Good question. The way in the Treasury guidance, they define utilities or as one of the non-payroll categories for allowable costs, utilities, and I quote, utilities for which services began before February 15th, 2020. So assuming that they broaden the definition of utilities beyond the actual utilities tied to real property, since they're talking about leasing or they're talking about rent, they talk about real property for mortgage interest. My concern around the definition of utilities is they were thinking of really more related to real property. For example, the lights and heat for your office space, and not for the non-real property related ones. But again, no guidance on that other than for any service that began before February 15th, 2020. Another question, loan forgiveness. It's not taxable. How does that work? So question on loan forgiveness, that's correct. The Treasury has stated that it will not be taxable for federal income tax purposes. However, we want to be clear, the state and local governments have not issued any guidance on whether they will also consider it non-taxable income as well. So you want to be prepared that there may be tax implications for that for your business. In addition, there are questions around whether the payments for salaries that you're making during the 8-week period that will be pertinent to your loan forgiveness. So the federal government says, okay, you've paid, $100,000 in salaries, your $100,000 loan is forgiven. Can you also deduct those loans on your those payments for salary? Can you also deduct those as costs for calculation of your federal income tax liability for the same year? Now that would seem like double dipping, but there needs to be clarification on that. So a lot to be settled on the tax front around the loan forgiveness. Another question, Anna, let's see. Are wages paid to temporary agency personnel included in payroll costs?
No, it is only anybody who receives a W-2 directly from you. So if the temp agency, they're on the payroll of the temp agency, so they're not included. Mal, you're giving me all the softball ones. Come on, man.
Well, okay. Well, here's one.
I think I'm going to regret this.
One question.
Right?
What? No. I mean, these are the same questions we've been battling throughout. One question I have is, how will loan forgiveness be viewed when comparing staff levels pre and post pandemic PPP in light of voluntary staffing changes, or if folks leave on their own versus through an organization's decision?
Yeah, I mean, this is going to be a challenge in bringing people back, assuming you use them and you have the work for them to do, whether you use any of our categories or you have other work for them. The unemployment is pretty lucrative for those low-paying employees, and to pull them back it is going to be a challenge. So you're at the mercy, not necessarily. I mean, you can always suspend benefits and things along those lines, but it may be hard to pull people back. Or likewise, if people voluntarily left, you don't get any forgiveness for that. That just goes against your calculation. It's pretty black. Well, I'm going to say it's pretty black and white. It's black and white enough to say that it is a headcount reduction and a salary reduction from that, the look back periods.
Great. And we have several questions on various aspects of the forgiveness process. When will it happen? Will it be with my bank or the SBA? When will I know how much of my loan is forgiven? And those are all excellent questions as well. And the forgiveness process has not really been discussed at all, only to the extent that they talk about having documentation, clear and adequate documentation to support all of the costs that you're saying that you spent the loan on during the covered period, those 8 weeks from the time of funding. So that's been largely the extent of it. No conversation around what the timing of it is. So it is possible that you will be out of your 8-week period before you know how much will actually be forgiven. There is some talk that the reason why the loan period doesn't need to start being repaid for 6 months from the time of funding, so there's a deferral period there, is that will allow the forgiveness calculation and approval to be done. However, we're not sure what that looks like, who will be doing it, and if whoever is doing it has incentives to keep the forgiveness portion as low as possible. For example, one of the unforeseen consequences of the big banks, not providing any guidance to the big banks, is that I'm sure you've read in all the papers, is that the banks really then just took care of what we're reading is that whether it's a belief or some of it's been documented, that the big banks took care of their big clients first. And I don't think that's in dispute because of the average size of the PPP loan was in the hundreds of thousands of dollars, which would suggest millions of dollars of payroll. And also taking clients, their customers that had lines of credit already with them as a way to protect their loans, the other loans that they had with those customers. So, I'm really curious as to what the forgiveness process is going to look like and what the safeguards are, that everyone gets treated fairly, that there is a dialogue about it, and it's not just an ironclad decision that somebody someplace calculates an amount and that you have no opportunity to refute that or argue that they didn't understand the documentation. So more to be seen on that. Let's see. Oh, go ahead, Anna.
No, there was a question came up about if you're a seasonal business and you don't need the same number of people during the 8-week period. Their guidance came out yesterday, I believe it is. I'm losing track of the days, about seasonal employees and the look back period. So I would just check the guidance because that came out. Depending on when your busy season is, it gives a little bit more flexibility. I think it only gave one time period before. Now it's expanded that. So I would just double check that. But for seasonal businesses, it does provide some sort of allowance for that.
Okay. Here's another question that we've debated back and forth. What is the definition of an FTE? Is it the same as the Affordable Cares Act, 30 hours, or is it 40 hours or some other number?
I think that is one of the concepts that need to be determined. It's funny, the way that they counted, the SBA normally counts heads is actual physical heads. And when they look at qualification for how do you qualify as a small business, they look at actual heads, whether it's full-time or part-time. But the law is very distinct that it is saying full-time equivalents, yet there is no guidance on what that full-time equivalent is. So that is yet to be determined. We're kind of going with the CARES Act because at least that was set in stone at some point in time. And so, that is one of those moving parts that we need to address, because it could be significant. It could be significant for certain businesses depending on how their business is operating.
Sure. Another question: if I have trouble consuming all of my PPP loan, can we advance pay bonuses inside of the 8 weeks? I realize you don't know the answer, but looking for your instinct.
I think. Judging from the way that they calculated the loan and tied back to the 941s, which is cash basis, my guess is that theoretically you could. My guess also is that they're going to get smart to this potential gaming of the system. So there may be clarification on that. So right now, the answer is yes, that you can pay somebody, prepay, advance, bonus, whatever it is, to kind of use up your funds and then get your loan forgiven. I'm just not so sure if that's not going to change as new guidance comes out.
Here's another question on the forgiveness side. Also, is I'm hearing this suggestion to open a separate account to put the PPP funds in. My bookkeeper is making the argument that we shouldn't open the account, that we should record it as a long-term liability in our chart of accounts in QuickBooks. Running a report from that account for the SBA as forgiveness at forgiveness time should be just as clear without the extra hassle of transferring funds back and forth to and from additional accounts set up at the bank. If you do suggest a separate banking account, should this be a checking account? And will we have to switch all our money? Will we have to switch all our auto pays over, start writing checks, and so on? So it's, you know, it's really the mechanics of, to me, what this speaks to is, what are the mechanics of documentation that you are going to need to provide for the SBA to grant, or whoever it is granting forgiveness? You know, I've seen both, you know, oh no, don't put it in a separate account, you'll be able to document it. Oh no, put it in a separate account, it'll be really clear. My instinct on that is to really make it as simple as possible for someone to get to, yes, your loan is forgiven, okay? I've seen on all the applications we've done, depending on what portal you put in, some portals are very literal in terms of what information they take and how they do the calculation. For example, there's one portal that will only consider your 941s in the calculation for your loan amount. Okay, so it didn't take into account any retirement or any health insurance or any of those other additions to your salary. Of course, it did back out the excess of $100,000 on employees. So that was an understated potential loan amount. So I have a feeling that the portals are probably going to be set up the same way, where they're not going to be, there may not be a human on the other end, or there may not be a human on the other end until somewhere in the process that you have to get through in order to be heard in terms of why you're arguing for what the amount that you want forgiven. So my suggestion again is make it as simple and crystal clear. You got $100,000 in. Here's, here are all the checks I cut for payroll for $100,000. I'm good. Now, obviously that's oversimplified, but the clearer the better. Again, make it easy for someone to get to yes.
Yeah, and to add to that point, there's two trains of thought here. I mean, the simplest way is to open a bank account with the PPP funds in, transfer those right into there, and then instead of reconfiguring all your auto withdrawals to that account, leave them where they are. What we're suggesting you do is, like, when you run payroll, transfer the exact amount of that payroll to from your PPP checking account to your other checking account. That's the easiest way to do it for record keeping, so that you show the actual amounts that go from one account to another. Obviously, you want it for documentation purposes. Make sure you have all of your invoices for health insurance. Funny, if your landlord doesn't give you statements, you probably want to start that process now and get statements from them that you, yes, in fact, paid. Those are all things that you want to start collecting as documentation. So one train of thought is having a separate bank account. Separate is if you have a sophisticated accounting department, you can use a general ledger account as long as the record keeping is really crystal clear. But the safest way to do it is probably to put that separate bank account, and it doesn't cost you that much to do that. It shouldn't cost you anything at all. Okay.
Yeah, great. So another question, do prospective clients' decisions to not go forward with programs count towards loss? Absolutely. I don't think it was conceived that there was only a single point of time where you experienced a loss or economic uncertainty. That to me speaks about forward thinking situation. So I would say, you know, if you're having conversations with clients and they're clear they're not going to continue programs, even better if you got it in an email from them or some kind of documentation, put it all together. You know, just create a file for yourself right now. So when you are applying for forgiveness, you are armed with a stack of really good indicators showing why exactly there was economic uncertainty in your business. I mean, we've had clients who depending on what business line of business they're in, have actually had a short-term uptick in their business, but that will be followed by a long-term downturn. So, you know, our suggestion there is document that. Your numbers will prove it out, and, you know, be clear on why you had the uptick and what the situations around that were, and then show the longer-term downturn. And,
you know, and it's a predictive thing. You know, you're anticipating that the economic issue. So even if in that client's case, for example, the uptick happened, they're expecting a downturn, and for some reason it upticked, then, you know, that they had the anticipation of the downturn. And if they document that, you know, nobody can predict the future. So I think it'd be hard pressed to say they really didn't need the money, but if they can say, okay, here's the reasons why, and like Mel said, document it, it's important.
Yeah, here's a note from someone. Separate accounts, my suggestion, lean on your payroll company to document the payroll. They're all gearing up to do this, plus the new tax codes for workers' comp, et cetera. Here's the challenge with the payroll company. What we saw in the first 2 weeks of the PPP application being launched was repeatedly some of the major payroll companies were not getting the reports correct. They were sending out reports to clients, and then we took a look at them and we were like, no, they're calculating this wrong. I mean, it was several iterations on some of them to get it right. So don't count on them as being really plugged in. I mean, it was stunning to me, actually, for the size of these and the sophistication of these companies, that they were not able to get clear on how they should calculate what the eligible salary costs were. So again, be really careful with that. Have somebody, you know, your CPA, tax advisor, whoever, give a look to that and make sure that it makes sense. And what was interesting is the way that the payroll companies were calculating it, they were understating the amount that was available to calculate the loan. So yeah, that was a double whammy for some of our clients who submitted early and used incorrect payroll reports. They unfortunately got loans that were smaller than they could have gotten.
That was before they worked with us, right, Mel?
Yes.
Let's see, what other questions came up? These are great questions, everybody, and I wish we had solidified answers for many of them. But like I said, this is a work in process. So I think, Mel, it looks like we've answered almost all of them.
I think so.
Okay. So I just wanted to thank you guys for your participation. It was, this is, like I said, an ever-evolving challenge for us. I would strongly recommend that you have somebody, this is not a DIY project anymore. You know, doing a loan calculation is good, but I think making sure that you are up to date on what's happening and how things are changing is important too. Also, if you, for example, were in the first batch of applications before some of the SBA clarifications came out, you know, in some cases, people submitted their loan calculations, including subcontractor costs. Make sure that you understand what truly is going into what you can take out of what is counted as payroll costs, so that you are fully aware that you may underutilize your loan, and it's okay to pay it back. It is also okay to keep it as long as you use it for those designated purposes. What we're most concerned about for our clients is maximizing the longevity of the business, not necessarily maximizing loan forgiveness, because they may be counterintuitive to each other. So I think we are going to wrap it here. Thank you all, and we will be running these again If you are interested, we have an open PPP loan forgiveness CEO roundtable that is on Mondays at 11 o'clock. I will send that out with the recording, the registration for that as well, and the recording, and that'll be up on our website shortly. So thank you, Mel, for your time and for managing the chat so perfectly. And for everybody else, thank you for your time this afternoon, and we hope to hear from you soon. If there's anything we can help you with, let us know.